very close to, if not the leading infrastructure advisor, particularly with regard to power, energy, transport. We have established ourselves in the last 3 years, particularly in South Africa, very rapidly so on the continent, as one of the most experienced and best balanced advisors.
KPMG, cutting through Africa's complexity. Download the KPMG Doing Business in Africa guide from the iTunes store.
A very good evening and a warm welcome to Personal Finance. I'm Kukulethu Cele. South Africans will see the introduction of new tax savings accounts from March this year. Now that's in an effort to incentivize personal in the country. In studio, I'm joined by Piet Nel, Project Director at SAICA, and Keith Engel, Deputy Chief Executive of the South African Institute of Tax Practitioners, or Professionals rather. But for a look at the nuts and bolts, both of you are going to help us understand what this means and why South African consumers should be happy about this. Keith, let's start with you. Tax-free savings plans, why are they being implemented?
As usual, government is always trying to promote savings, and this vehicle is designed to hit low income. That's really what it's going for. So to the extent that your savings can grow tax-free, that's always a nice thing.
That's a nice thing, Pete. I'm sure you also agree, but what does it entail exactly?
Yeah, look, we agree that the government's doing the right thing to incentivize it in that lower field to make people save more. It entails making use of existing financial instruments. So the tax-free investments itself is current bank accounts. There's a regulated list of the entities that can provide that, and it would entail that your return on the investment is tax-free. So that means that your after-tax return is effectively your investment return. And if you exit or dispose of the investment, then it's also tax-free. It allows for you to roll it over, but principally the capital gain, if there's growth in that, would be tax-free. And it's not limited to interest only. So it's all the proceeds, capital and revenue on that investment is free of tax.
Going back to your first point, whether taxpayers should be happy or not. Now, some will be happy, some won't. Now, the proposal for low income, there'll be definite winners. The one downside that they've mentioned in the side of the proposal is there's a 20,000 interest exemption. Now, that's been going on for many, many years. What Treasury has said is they actually want to phase that out.
Hold on, Keith. You're losing us a little bit here. Explain this a little bit further. So it's for the lower income group, but this 20,000 exemption, where does it fit in?
Well, what happens is for many years we have an exemption for interest. So if you put money into a bank account, any bank account, 20,000 tax-free. So you don't need a special account for that. What Treasury is saying is they're going to create this new account for low income, but your 20,000 interest exemption will be phased out over time. So the proposal has some pluses and minuses.
So in other words,
I agree with that. And in essence, at the moment, if you invest money in your own business, you say you've got your own company on that loan account, you can earn interest on that and not be taxed on that up to the first 22,000 odd rand. Now with the new investments, and when that is not one of the regulated or one of the approved investments, so over time that benefit will disappear. They will maintain that amount. That's what the minister said last year. So, but they will phase it out in future. And
so this is an attempt to basically ensure that almost everybody has some kind of tax-free savings vehicle.
What they're trying to do is shift it more in favor of low income. Yeah. So the question then is that a good thing or bad thing? A lot of people say, well, rich people save anyway, so why do we need to give them an incentive? The counter argument is savings is always good. So we should not discourage that. But I'm just saying from a personal finance point of view, there's going to be some winners and losers in this. The real question is the new account mechanism. Is that a good account mechanism? And what do you think about the account mechanism?
Well, I think that is limited, but yes, I think it is a good mechanism to allow for that. So, and the way it's structured and giving people the opportunity, the problem was, and that was part of the phasing out of that, is that if they had immediately replaced the tax-free investment and taken away the old 20,000 exemption, that would have been a train smash for most investors. So now they have a transitional period. You can get in at 30,000 rand a year. There are some, and then you limit it to 500,000 rand over all investments. So
I also wanted to touch on those limits, and maybe let's speak to the higher LSM audience here that has already has their savings investments established. Surely this can be added on as a bolt-on to your retirement annuity. Is it an option?
Yeah, look, I think for those people, you have a comprehensive investment package. So this would mean that in the first year and up to the 500,000, when you make up the full amount, you've got an additional amount of interest that is exempt from tax. So it makes part of your whole plan that you will have those investments that will give you tax-free return. It is not similar to a retirement annuity, because they allow you a tax deduction when you contribute to your retirement annuity funds, whereas this is limited, but there's no tax deduction, so to speak. So you only get the return tax-free, whereas the investment into a retirement annuity, SARS or the government in a sense contributes to that, and it also grows tax-free in that investment. Keith?
Yeah, no, I agree with that. I think this is not, retirement is long term. This is more of a shorter term.
That's a good point.
3 to 5 years. So when you put the money in, this is the idea for short-term savings on the side. But what it offers, and I think what he's getting to, is flexibility. So in a retirement, you put you've got to do a bunch of things to get it out. Here, you can get it out any time. It's much more flexible. But the hope is that if it's going to grow tax-free, you're just going to want to keep it in there longer. But it has pros and cons. So the other one, your interest is free up to 20,000, and it's simple. The only thing is it's limited to interest. What the government is trying to do is they're trying to say this new vehicle can be unit trust, it can be anything. So it's
even exposure to equities, maybe, because that's what some people want.
Yeah. So the dividend income would then also be free from the tax itself. Yeah. Collective investment schemes, as Keith has said, and also certain insurance policies that they've approved.
Yeah.
So an investment in probably and some an endowment policy would also get the same treatment there.
Yes.
So just on that, Keith, I know you have a lot of sentiment that you want to share on this, but I'm happy for you to go ahead. But just on this, you're trying to get the poor to save, you're incentivizing the rich as well. But how exactly do I get exposure to it? And you mentioned as well with regard to deposits over a lifetime, as well as deposits in the short term. Are those also rules put in place that if you do have exposure to other modules,
what Keith said, the old system was a lot simpler than the current one. So there's a lot of rules, and if you actually get it wrong, there's a penalty. So if you invest more than what you're entitled for the year, then you end up with a penalty. So
why is that, though? Is that just assuming that if you have more money, you can actually go to a stockbroker and invest your money with them?
Look, the penalty is based on the fact that you then have more than, let's say, the 500,000 cumulative amount invested in that. And then you not only lose the tax exemption, they make you pay a penalty because you have exceeded the limit. So it's a lot more complex than the old system. Yeah. But to get into it, it's a matter of going to a finance share or a bank or whatever it is, ask them which are the products that are approved and qualify as these tax-free investments, and put your money in there.
And Keith, I think maybe this is a point where we really need to emphasize the losers segment here, because you mentioned the penalties as well as exemptions on the tax-free deduction. So who is this really directed to? If I'm sitting at home trying to figure out if I qualify for that bracket, am I that person?
You can be. I think you can be. The only question really is this is a more complex vehicle. So I think this is one you're going to have to work through your broker and others. And really what it is the service providers. Can the service providers provide it? What they're really trying to do is a glorified Mzansi account. That's what they're really trying to do. And what they're saying is if you're already super rich, all those other benefits should fall away. Now the question is how do you direct things to the poor or to the low income or the middle income? That is always required, and that's where there's more rules. But once there are rules, there's more complexity. Then it starts to raise some of the cost of setting up the thing. So if it's costly, what's going to happen is instead of getting the growth that you might get the growth without the tax, but then the administrative fees are going to go up. And there are risks for the providers. So a lot of the controversy around this is how easy is this so that it's easily provided by the providers. And I think government is trying to extend to multiple range of instruments, but there's a whole bunch of technical things that him and me will talk about for hours, but we'll bore you to tears with.
Never.
So we don't want to do that. So the only issue you'd have to watch on this, and frankly you'd have to watch it anyway, is here I have a taxable vehicle. What's the growth? And you want to compare the after-tax growth with this, with the other, the tax-free growth. And you might find there's some hidden fees with this. Maybe not. But really, it's always at the end of the day you look after tax. So sometimes you get the allure of tax, and you forget that really it's all about growth at the end of the day.
Exactly.
So,
how does this thing guarantee, or what's your view on the success rate of this? I know there's similar products that have been launched internationally in places like the UK, but the expected outcome, especially given the complexities that you've highlighted from a South African view?
Well, I have one view in the sense, and we look at all the reports and that were leading up to the legislation itself. I think the man in the street or the lady in the street just doesn't have the excess money to invest. So, I mean, the low-income people are, whatever they're earning, they are spending. We've had some relief now with the petrol price coming down and so, but it's still, I have the sense that people just don't have the money to invest in that. Certainly we see that in our members where people earn reasonably incomes or paying taxes and just don't have any investment income. So it looks like maybe that the real fact is that they don't have the money to put that in. So but we're saying that there is an incentive. So if you have some excess money and put that in, then you'll get the benefit. So.
Exactly. But does the model maybe need to be relooked at? Are you in liaisons maybe with Treasury?
Yeah, I mean, the model will not change that. The fact that you don't have the money to make the investment will not change that. It does, I think, the SAICA's view is that the fact that you have that tax incentive is a stimulus to decide to make the investment. So, because, you know, you look at that and you say, okay, well, I don't have to worry about tax if I make this investment. So,
Keith, maybe we should get some closing pointers for you, because there are a lot of people who'll be watching this at home and wondering if the tax-free account is for them. And as you mentioned, Piet, earlier, there's just such a vast amount of products available. The game plan that one needs to have as they leave the show today when it comes to tax-free savings accounts, what should be the top 3 things that they look for?
Look, the bottom line is what you're looking for is growth. So the question here is, when you look at this after tax, is it better than a taxable instrument? So really it's going to come down to not so much government, but the service providers who provide it. So in a simple case, let's just say banks. The banks who are providing this kind of deposit versus something else, you then make that comparison. I think those deposits you'll be better off. The question is when these other things, because government's trying to bring in, the government is trying to make sure you're indifferent as to what investment vehicles use. The question is the other ones are a little bit more complicated. So will you get the better after-tax return or not? And if you can, then do it. But that really, you're going to need a broker. You're going to have to do an analysis. So it's just one more
some research.
That's you.
Do you agree with that as well?
Yes, I agree. Yeah, you must do some research. And I mean, we haven't seen the products being offered by the banks yet. So they all have geared up for this. And all the providers, the collective investment schemes as well. So I agree with Eve. You must. What is driving this is if you know that it's tax-free, so understand the investment product, look at the return that they're offering, and know that there are no taxes on that.
I'll tell you what, gentlemen, I think we're going to have to get you back in again following March when South African consumers are actually out there trying to get into these investment vehicles. Thank you so much for your time, though, this evening. That's it for Personal Finance tonight. Thanks once again to Piet Nel, Project Director at SAICA, and Keith Engel, Deputy Chief Executive of the South African Institute of Tax Professionals. Remember that we'd love to hear from you, and give us your as to what you make of tax-free accounts, or also send us your comments on @CNBC Africa on Twitter using the hashtag Finance410, or tweet myself @Kukumfupi. But until next time, it's goodbye for now.
But it makes my heart glad to see talk of trams coming back.
I thought you were going to say it makes your heart glad to see me next to you.
We don't know what to expect now. Looking at the big story, yesterday we had Tanzania becoming the largest export market for Kenyan goods in the region.
You know, we believe it's the most exciting sport in the world to watch, and the numbers show it. We get great turnouts at live events.